Hello, learners. Welcome to Cost Accounting, where we'll tackle the topic on cost volume profit analysis. As a runner, you're supposed to know the definition of what is cost profit analysis, the CVP models or the cost volume profit models, the assumptions, and also the CVP analysis formulas. We'll also be having an illustration to understand more what is cost volume profit analysis, and also later we'll be having a question. So let's define first what is cost volume profit analysis. It is a technique that allows the study of the relationship between the cost, volume, and the profit. And we usually say that the profit is a function of cost and volume. Is usually a function of cost and volume. So that is a good introduction of what is cost volume profit analysis. So once you do this analysis, there are various questions that you're supposed to answer or to ask yourselves. So at a CVP analysis, you're supposed to answer the following questions. One is the product or service that you're supposed to emphasize on, or which product as an organization you're supposed to produce. Then, the minimum level of sales which are needed to be achieved to avoid losses. Remember, each and every goal of an organization is to make profit. So they have to know at what level they have to make some sales and ensure that they are earning some profit on top rather than getting some losses. Then, what should be the sales level to earn a target profit? We give ourselves some targets. So, what will be the sales that you're supposed to make so as to achieve that target that we have set? Then, what will be the effect of the changes in price, cost, and volume on profit? For example, each and every year, you find that the Minister of Finance is reading the budget and the prices of product keep on changing. So, in case we increase the price of a certain product, what will happen to the profit? In case we change the cost of production, what happens on the profit? And in case we increase or reduce the volume, what then is the changes in terms of the profit? Then which product is profitable and which one is least profitable? So you make some comparison between the two items there that you have in your organization. Then should sales of a product or operation of a product of a plant, be discontinued? So you have different branches in different towns. So you have to make some analysis so as to find out if you're going to continue with that branch. Also, are you going to continue with the operation of the current plant that you have? So this is the CVP analysis will assist to answer these questions. Then, should the farm be shut down temporarily? Right now, there have been issues with COVID. So in that period, should you shut down your businesses temporarily? Then, decisions on whether to increase or reduce the fixed cost. So the fixed cost usually increases the cost of the organization. So, in that sense, are you supposed to increase the cost again? And what will be the ripple effect in terms of profit? So, the CVP analysis will assist you to answer those questions. Then, the amount to budget for discretionary expenditures, such as, for example, we have there the advertising. So, in case I increase the advertisement cost, what will be the changes in terms of profit? Because here we are planning for the profit. And you find that CVP analysis is usually carried out in the short term. And in that short term period, we usually have different type of costs that are incurred. And in the short run, we usually say that we have the variable cost, the fixed cost, and also the semi-variable cost. And right when you go to the long run, whereby we only have the variable cost, the costs keep on changing in the long run. But in the short run, we have the fixed cost and also we have the variable cost. So that is a good introduction of what is CVP analysis. So the next thing that we said we'll be tackling is all about the CVP models. And we have two types of models are the CVP, that is the basic or the certainty model. We also have the stochastic or the uncertainty models. However, under this stochastic or uncertainty model, we have three approaches in this model. That is the expected value approach. We have the continuous and probability distribution. We also have the simulation techniques. Those are the three items that are required in this model under the stochastic or uncertainty model. So we start with the first one there, of which we are going to tackle today. That is the basic or the uncertainty or the certainty model. The basic or certainty model has the assumptions which are derived from the CVP, and that means that we have the first one there. All costs can be separated into fixed and variable cost. Hence, total cost is equivalent to fixed cost plus the variable cost. Fixed cost plus the variable cost. Fixed cost remain constant over relevant range. Fixed cost remain constant over relevant range. Then the other one is that the unit variable cost and the selling price would remain constant. They do not change. They are just constant. The total produce is equal to total sales. And one product is produced and sold. The volume is the only driver or the factor affecting the cost and profit. Then there is linearity in the cost and profit function. You also find that there's assumption that the level of technology, efficiency, and production method usually remains constant. There's no time value of money that is considered here. There are no demand, restriction, and constraints. So those are the assumptions that guides the CVP analysis. Hence we go to the next level that we have stated earlier, that is the CVP analysis formulas. And under the CVP analysis formulas, we discuss the various formulas that are in the CVP analysis. We find that the revenue function is usually calculated as revenue is equivalent to the price of a unit multiplied by the units that are being sold. And the price is denoted as P, and the units sold are denoted as X. Hence, revenue is equivalent to the price multiplied by the unit of sales. So those units that have been sold, you multiply together with their prices. The next item is the cost function. And the cost function has the fixed and the variable side. So under the variable, we have the V denoted as V multiplied by the units that are sold, that is the X plus the fixed cost. Then we have the profit function, and you should say that profit is equals to revenue minus cost. Revenue minus cost. So profit is the difference between the revenues and the cost. So simply, to derive the function, we just equate those values under the revenue minus the values under the cost, simply as that. So once we solve the equation, we find that we are left with x at the end there into bracket p price minus the variable cost minus the fixed cost. The selling price minus the variable cost is usually equals to the contribution margin. Is usually equals to the contribution margin. Hence, we find that the profit function can also be rewritten as the contribution margin multiplied by the units minus the fixed cost. So these are in terms of units. So this profit is in terms of units. What about in terms of shillings? So we have simply to equate that, and we found that revenue is equivalent to price times the unit sold. Hence, those units can also be rewritten as revenue divided by the selling price. So once you solve that equation there, you find that the profit function can also be rewritten in terms of shillings as the contribution margin ratio multiplied by the revenue minus the fixed cost. Minus the fixed cost. The next formula is the break-even point in terms of units and also in terms of shillings. The break-even point in terms of units is usually equals to the fixed cost divided by the contribution margin. Whereas, in terms of shillings, it is equals to the fixed cost divided by the contribution margin ratio. We can also have another formula under the target sales. Here is all about the issue to do with discretionary expenditures. So if we have a target sale that you want to achieve, you find that in terms of unit, fixed cost, we have to add the target cost divided by the contribution margin. Whereas in terms of shillings, you only divide with the contribution margin ratio. With the contribution margin ratio. So those are the formulas that we can use under the cost volume profit analysis. So we can now have a scenario or a practical scenario under the question here, which states that Bahati Limited manufactures three products whose average annual sales units are as provided below. We have the products there and their sales units in terms of thousands. A is 500,000, B is 1 million, and we have the C, which is 400,000. We are told that the unit selling price of product A and B are shillings 30 and shillings 20 respectively. The unit selling price of product A and B are shillings 30 and shillings 20 respectively. So it means that the price of A is 30, the price of B is 20, hence you are not given the price of C. But you are told also that the product A and B have variable cost to sales ratio of 40%. So the variable cost ratio is 40%. That is for A and B. We also find that product C has a contribution margin ratio of 37.5% and variable cost of shillings 25 per unit. So already there, we are told that that product C has a contribution margin ratio of 37.5%. Now its variable cost is just shillings 25 per unit. We also given other information here that the company intends to increase the expenditure on production and advertising on product A by shillings 800,000 and reduce its selling price to either shillings 25 or 20. The estimated sales increase as a result of the reduction in price will be 800,000 units and 1.2 million units for unit selling price of shillings 25 and shillings 20 respectively. So that is what you are given there. Then you also told that the fixed costs are currently shillings 18 million. The fixed costs are currently at shillings 18 million. The required. What is the break-even sales in units? What is the profit function? Finally, you are told to advise the management of the company on the price to adopt for product A given the promotion activity. Given the promotion activity. Here you find that the promotion activity is given in Roman 4. So how do we handle this question here? Simply, we have a solution. And we start us with a summary of the information that we have been given. Hence, we have the details and we have been given, we have product A, B, and C. We have been told that the selling price of A is 30, of B, we are told, is 20, according to the question there. But you're not given the price of C. We also told that the variable cost of C is 25 per unit. In shillings, 25 per unit. So with this information here, we can be able now to compute further by the values that we are given, add the question that we are told that product C has a contribution margin ratio of 37.5% and a variable cost of shillings 25 per unit. But before that, in Roman 2, we are told that product A and product B have a variable cost to sales ratio of 40%. Of 40%. What does that mean? Is that the contribution margin ratio formula is equivalent to 1 minus the variable cost ratio. And the variable cost ratio is equivalent to the variable cost over the selling price. But we are told that in the question is that the variable cost to sales ratio is 40%. So what you're supposed to look for is the variable cost for A and B. We equate as such, and we have been told already that the variable cost ratio is 40%, that is 0.4, is equivalent to V, which is the variable cost, divided by the selling price of A is 30. So by the end of the day, we find that the variable cost of A is 12. Is 12. For B, the same case applies, but here we find that the selling price of B is 20. Hence, the variable cost will be equivalent to 8. Further, in the question under Roman 3, we are told that the product C has a contribution margin ratio of 37.5%. And already we have seen the formula for the contribution margin ratio, which is 1 minus the variable cost divided by the selling price. So the same case we apply here, and we find that for C, we have already been told that the contribution margin ratio is that 7.5%. But here we have the variable cost of C is 25. So now the selling price will just be equated, and we find that the selling price is equivalent to 40. So from that summary that we have there is that we already have the selling price and the variable cost for product A, B, and C. So the next step is to look for the contribution margin. And the contribution margin is usually given as the selling price minus the variable cost. The selling price minus the variable cost. So here for A is 30 minus 12, which gives you 18. For B is 20 minus 8, which gives you 12. And for C, you get 15 after deducting 40 minus 25. So that is the contribution margin. So then the next step is look for the contribution margin ratio. The contribution margin ratio. And we say that the contribution margin ratio is equivalent to the selling price minus the variable cost divided by the selling price. Hence, we already know what is the selling price minus the variable cost, which is 18. So we already divide now with the selling price, which is 18 divided by 30, and that gives you 0.6. For B, it is 12 divided by 20, and that gives you 0.6 again. But we already given that the contribution margin ratio for C is 37.5%. But you can try and see if it's equivalent to that. So that is 15 divided by 40, and we find that is 37.5%. So with this summary here, we can be able to tackle Roman 1, which was telling us to compute for the break-even sales in units. And we already know that the break-even sales in unit can only be given by fixed cost divided by the contribution margin. However, here we have 3 units. We have to compute for the weighted average contribution margin. And how do we do that? Is that it is given by the weight of 1 multiplied by the contribution margin of 1 plus the weight of 2 multiplied by the contribution margin of 2 plus the weight of 3 multiplied by the contribution margin of 3. How do we get the weights? How do we get the weights? Already in the question, you see where we have the sales, and the sales are in terms of 500,000, 1 million, and 400,000. So the weights can only be distributed as such, whereby we have 500,000 is equivalent to, or is in the ratio of 1 million and 400,000. So that can be solved simply by having such, and that totals to 19. So to compute for the weighted average contribution margin, here we have to multiply the weight of 1. Here is the weight of A, which is 5 now. And that weight we multiply against the contribution margin, which is 18. So the weight of 1 is supposed to be 5 divided by 19. Weight of B is 10 divided by 19, and the weight of C is 4 divided by 19. And hence we have the weight, or the weight of 1 multiplied by the contribution margin of A, which is 18, and you get it as such. For the same happen to the next, that is B, where we have 10 divided by 19, that is the weight of B, multiplied by the contribution margin, which is 12, plus we have the weight of C, which is 4 divided by 19, multiplied by the contribution margin, which is 15. So by the end of the day, what you get there is that you'll get a figure which is shillings 14.2105. So that is the weighted average contribution margin. So now, what is the break-even sales in units? Which is simply 18 divided, and remember 18 million was the fixed cost, divided by the weighted average contribution margin, which is 14.2105. You get the value of the break-even sales in terms of unit as 1,266,669 units. 669 units. So that becomes the break-even sales in terms of units. That is the answer to Roman 1. But Roman 2 was telling us to compute for the profit function. For the profit function. Under the profit, we said that in terms of unit, profit function is equivalent to the contribution margin multiplied by the number of units minus the fixed cost. But remember here, we are talking about 3 units. So it is the weighted average contribution margin multiplied by the number of units minus the fixed cost. Already we have found that the weighted average contribution margin was 14.2105. And the number of units, we found them to be 1.9 million. Once we added 500,000 plus 1 million plus 400,000 units that were sold. So the total to 1.9 million. And you already know that the fixed cost is 18 million. So simply we equate that and we get the value as shillings 9 million. So from the profit function is that we can get a profit of 9 million. We can get a profit of 9 million. Roman 3 tells us to compute or to advise the management of the company on the price to adopt for product A given the promotion activity. given the promotion activity. And under the promotion activity, we are told that the company intends to increase the expenditure on promotion and advertising on product A by shillings 800,000 and reduce its selling price to either shillings 25 or shillings 20. The estimated sales increase as a result of the reduction in price will be 800,000 units and 1.2 million units for unit selling price of shillings 25 and shillings 20 respectively. So that is what you're supposed to use so that you can advise this management on what to do. So we find that under product A, we have a profit function, which is the contribution margin multiplied by the unit fare minus the fixed cost. And in this sense here, we find that the fixed cost has changed to a promotion cost. Under the current situation, under product A, we are going to compute the selling price minus the variable cost, whereby we found that the selling price was shillings 30 and the variable cost was shillings 12. But the units sold here are 500,000. But in that sense, under product A, there is no promotion cost. So we'll be having such an equation. So currently, product A has that effect and it is making a profit of 9 million. But we have a proposed prices which is shillings 25 and shillings 20, which has an issue with the changes in the number of units. At the 25 shillings, it will change with a promotion cost of 800,000 and the same price. In case we have a promotion cost of 800,000, the unit will increase to 1.2 million. So we have to make an advice here by looking on the two issues of the changes in prices. In the proposed prices, at the prices where we have price shillings 25, changing from 30, we have to increase the number of units or the number of units changes to 800,000 and the promotion cost is 800,000 there. Hence, that equation will lead that we have a selling price minus the variable cost multiplied by the units that will be sold there, that is 800,000, but the promotion cost will be 800,000. That will give us a profit of 9.6 million. A profit of 9.6 million, which is now higher than what we have currently. Let us see now, in case the price changes to shillings 20, you find that we'll be having such a scenario. The selling price is 20 minus the variable cost of 12, and now the unit that will be sold is 1.2 million, but the promotion cost still holds at 800,000. You find that the profit that you're going to make there is 8.8 million. Is 8.8 million. So in comparison with what you have currently and with the changes of prices, we can be able to advise the management by seeing that, by taking the point that the one that gives us higher profit should be adopted. You find that at the shillings 25, the profit increases by 600,000. But at the price 20, the profit declines. So, we would rather choose whereby we have proposed changes of prices at shillings 25 and the units are being produced there or are being sold is 800,000. So, we advise the management by saying that the company should adopt selling price of shillings 25 and shillings 800,000 promotion cost so that they can earn 600,000 increase in profit. 600,000 increase in profit. So that is the best advice we can give to this organization here. I think you enjoyed the running. Thank you for attending here at Karasha Solutions. You can reach us for any consultancy at karashasolutions@gmail.com. Our website is karasha www.karasha.co.ke, and the contact are 0782 515 725. Thank you very much for attending. See you next as we solve another question under the CVP analysis.